Most people think investing is about finding the perfect stock, the next big crypto, or a secret strategy that makes you rich overnight. But real investors know something most people don't. Investing is not about luck, it's about mindset. The difference between someone who struggles financially their whole life and someone who builds long-term wealth is not intelligence, it's how they think about money, time, and risk. If you want to think like an investor, the first thing you must understand is this: an investor does not chase money. An investor builds systems that make money grow. The average person thinks like a consumer. They earn money and immediately think, what can I buy? An investor earns money and thinks, how can I multiply this? This is the core shift. Consumers trade time for money and then trade money for comfort. Investors trade money for assets and assets for freedom. An investor looks at every dollar as a worker. Instead of spending it, they ask, where can I send this dollar so it comes back with friends? This mindset alone can completely change your financial future. Another major difference is how investors see time. Most people think short term. They want fast results, quick profits, instant success. Investors think in years, sometimes decades. They understand that real wealth is built slowly, quietly, and consistently. While others are chasing trends, investors are building positions. While others are panicking during market crashes, investors are calmly buying more because they know something important. Time in the market is more powerful than timing the market. Investors also understand the power of compounding. Compounding is when your money starts making money, and then that money starts making even more money. It's like a snowball rolling downhill. At first, it's small and slow, but as time passes, it grows bigger and faster. Most people ignore compounding because it looks boring in the beginning. Investors love it because they know that the real magic happens later. They're willing to wait because they understand that patience is not weakness, it's a competitive advantage. Another key trait of investors is how they see risk. Normal people think risk means losing money. Investors think risk means not understanding what they're doing. To an investor, the biggest risk is staying ignorant. That's why investors spend so much time learning, reading books, watching markets, studying businesses, understanding financial statements. They don't gamble, they calculate. They don't guess, they analyze. The more they know, the less risky investing becomes. Investors also separate emotions from decisions. This is extremely important. Most people buy when everyone is excited and sell when everyone is scared. Investors do the opposite. They buy when things are undervalued and ignored, and they sell when things are overhyped and overpriced. They don't follow the crowd because they know the crowd is usually late. Investors train themselves to stay calm when others panic and stay cautious when others become greedy. One of the most powerful investor habits is thinking in probabilities, not certainties. They don't ask, will this make me rich? They ask, what is the likelihood this works over the long term? They accept that not every decision will be perfect. Some investments will fail. Some will underperform. But overall, their system wins. Investors focus on building a portfolio of smart decisions, not one lucky bet. Finally, real investors think like business owners, not lottery players. When they invest in a stock, they don't see a chart, they see a company. They ask real questions. Does this business solve a real problem? Does it make consistent profit? Does it have a strong brand? Does it have a future? They don't care about daily price movements. They care about long-term value. Because in the end, investing is not about predicting prices. It's about owning value and letting time do the heavy work. Once you understand the mindset, the next step is developing investor habits. Thinking like an investor is not a one-time decision. It's a daily practice. It's about training your brain to see opportunities where others see problems and to stay disciplined when emotions try to take control. Investors build routines around learning, tracking, and improving. They regularly review their finances, monitor their investments, and reflect on their decisions, not to stress, but to get better. Because in investing, self-awareness is just as important as market awareness. Investors also understand that income alone will never make them wealthy. High income with poor financial behavior still leads to a broke life. That's why investors focus on the gap between what they earn and what they spend. This gap is called investable surplus, and it's the real foundation of wealth. The bigger the gap, the more fuel you have to build assets. Investors don't try to look rich, they try to become rich. They control lifestyle inflation and delay gratification diversification because they know every unnecessary expense is an opportunity cost for future freedom. Another powerful way investors think is in terms of opportunity cost. Every financial decision has a hidden cost. If you spend $1,000 on a phone upgrade, that money can no longer be invested. Investors always ask, what am I giving up by choosing this? They compare options not just based on pleasure, but based on long-term impact. This is why investors often make boring decisions that look unattractive to others, but are incredibly powerful over time. Investors also diversify, but they do it intelligently. Normal people think diversification means owning many random things. Investors know diversification means managing risk without killing returns. They spread their money across different assets, stocks, index funds, businesses, real estate, even skills, not because they are scared, but because they are strategic. They understand that no single investment should control their entire future. Another key principle is that investors focus on process, not results. Beginners obsess over daily profits and losses. Investors obsess over whether their strategy is logical, consistent, and repeatable. They know short-term results are noise. Long-term results come from following a strong process again and again. This is why professional investors don't celebrate wins too much or cry over losses. They stay neutral and stick to the system. Investors also know the difference between being busy and being effective. They don't jump into every new trend, every new coin, every new stock tip. They filter information carefully. They understand that attention is a limited resource. Instead of chasing everything, they go deep into a few areas they understand well. Depth beats speed in investing. One of the biggest mindset shifts is understanding that wealth is built more by behavior than by knowledge. You don't need to be a genius. You need to be consistent. You need to invest regularly, stay patient, control emotions, and avoid stupid mistakes. Most people fail not because they chose bad investments, but because they quit too early, panic too often, or get greedy at the wrong time. In the end, thinking like an investor means accepting a simple truth. You will never outperform your own mindset. Markets will go up and down. Trends will change. Strategies will evolve. But your habits, discipline, and long-term thinking will decide everything. The goal is not to get rich quickly. The goal is to build a system that makes getting rich inevitable. At the highest level, investors think in terms of identity. They don't say, I am trying to invest. They say, I am an investor. This sounds simple, but it changes everything. When you adopt the identity of an investor, your decisions automatically shift. You start asking different questions. You stop reacting emotionally. You begin acting in alignment with long-term wealth, not short-term pleasure. Your brain starts filtering the world through one lens. Will this move me closer to financial independence or further away from it? Investors also understand leverage, but not just financial leverage. They use three types of leverage: money, time, and knowledge. Money is obvious. You invest capital to generate returns. Time is even more powerful. You allow years to pass without interrupting compounding. Knowledge is the hidden leverage. You use learning to make better decisions with less risk. The smartest investors don't work harder. They position themselves smarter. They put themselves in environments, systems, and networks where growth becomes natural. Another advanced way investors think is in terms of asymmetry. They look for situations where the downside is limited, but the upside is huge. This is called asymmetric risk-reward. For example, investing small amounts regularly into high-quality assets over time. The worst case is manageable, but the best case can be life-changing. Investors avoid situations where they can lose everything for small gains. They always want the odds in their favor. Investors also build personal conviction. They don't blindly copy others. They study, decide, and then commit. This conviction helps them hold through volatility. When markets crash and headlines scream fear, investors don't panic because they know why they invested in the first place. They trust their research more than the noise. This is why most people sell at the bottom and buy at the top, while investors do the opposite. Another key trait is that investors think in terms of ownership, not consumption. Ownership means equity. It means having a piece of something that produces value. Companies, platforms, content, intellectual property, businesses. Consumers pay monthly. Investors get paid monthly. This shift from paying to owning is one of the biggest secrets of wealth. wealth. The rich own what the poor rent. Investors also respect cycles. They know everything moves in cycles. Markets, industries, economies, even emotions. There are times to be aggressive and times to be defensive. There are times to buy heavily and times to wait patiently. Investors don't expect straight lines upward. They expect volatility. They plan for it. They prepare for downturns before they happen. Finally, elite investors think about legacy, not just lifestyle. They don't ask, how can I get rich? They ask, how can I build something that lasts? They think in generations, not just years. They focus on building assets, systems, and skills that can create income even when they are not working. This is the final level of investor thinking, moving from making money to building wealth, and from building wealth to building impact. At this stage, investor thinking becomes deeply internal. It's no longer just about strategies, markets, or assets. It's about self-mastery. The greatest enemy of an investor is not inflation, recession, or market crashes. It's their own psychology. Fear, greed, impatience, and ego destroy more wealth than any external factor. That's why the best investors spend as much time understanding themselves as they do understanding the market. Investors train themselves to become emotionally neutral. They don't let good news make them overconfident or bad news make them desperate. They understand that emotions are temporary, but decisions are permanent. When a stock goes up, they don't feel like geniuses. When it goes down, they don't feel like failures. They detach their identity from their outcomes. This emotional discipline allows them to stay rational in situations where most people become irrational. Another high-level trait is delayed gratification. Investors are masters of saying no to today for a better tomorrow. While others upgrade their lifestyle with every small income increase, investors lock in their habits and redirect the extra money into assets. They don't need to prove success through expensive things. Their real goal is control. Control over their time, their choices, and their future. They value freedom more than status. Investors also think in terms of anti-fragility. This means they don't just try to survive chaos. They try to benefit from it. Market crashes, economic downturns, and global uncertainty are not threats to investors. They are opportunities. When prices fall, investors see discounts. When others panic, investors deploy capital. They design their financial life so that volatility works in their favor, not against them. Another powerful concept is margin of safety. Investors always leave room for error. They don't invest money they can't afford to lose. They keep emergency funds. They avoid overconfidence. They assume that some things will go wrong, and they plan for it in advance. This mindset keeps them alive in the long game, because in investing, survival is more important than speed. Investors also understand that information is not the same as wisdom. The internet is full of data, charts, predictions, and opinions, but investors filter aggressively. They focus on signal, not noise. They don't consume content for entertainment. They consume it for insight. They choose quality over quantity. One good book is more valuable than 1,000 random tips. Finally, the ultimate investor mindset is responsibility. Investors take full ownership of their financial life. They don't blame the government, the economy, their family, or their background. They accept that no one is coming to save them. This mindset is not depressing, it's empowering, because once you accept full responsibility, you gain full control. And when you have control over your decisions, habits, and systems, wealth is no longer a matter of luck. It becomes a matter of time.